All right, everybody. Welcome to a live recording. I guess they're always live. We just post them a little later, but it's a live recording of the Sherman Show podcast. I'm Jeff Sherman, and I have my co-host Sam Lau with me.
Hey, hey.
And today, as you guys are well aware in the crowd, we have Barry Ritholtz. Barry is the CEO of Ritholtz Wealth Management.
No, that would be Josh Brown.
Oh, I'm sorry, you're CIO. Gosh,
CIO Chairman.
Man, you know, you can't keep it straight.
Don't tell Josh he was fired. He
Right.
was very upset about that.
You know, I think you gave me a promotion last time I was
I
on your
did.
podcast,
I do
so
that
I'm
all
just
the
returning
time.
the favor. How's that? Yeah.
In fact, during the podcast, people start out at like associate VP. By the time we're done, they're chairman and founder.
Yeah.
I work my way up the titles.
That's beautiful. But today, as you're well aware, is Tuesday, September 13th. I do that for compliance reasons, so they know all of the things we're talking about are as of today.
2022. Let's throw
yeah.
that into
You
for
see,
compliance.
I'm just really bad at this. So, so with that, let's start off. So, Barry, we're at this Future Proof Wealth Conference, right? It's a festival.
A
right?
festival, yes.
Right? It's a festival. We're in Huntington Beach. We are literally on the beach right now. What made you want to put this type of event together?
So we had done a number of events with Matt Middleton and John Swolfs. They used to be with Informa, and we had done events, the Inside ETF event. We put on our own event in Scottsdale, Arizona called Wealth Stack in 2019, and we had all these great plans for 2020, and I don't know what happened. We kind of dropped the ball, and nothing happened. And so last year...
So you're responsible for shutting the entire economy down.
Yeah, that's us.
Yeah, okay.
And then about 14 months ago, they came to us and said, hey, how do you guys feel about, getting the band back together and going on the road? Yeah. Great, but, when we did the events at Laguna Beach, it was like 20% outside. Can we do a little more, like 25, 30? And they're like, how about 100%? Yeah, we could do that. How can you make that happen? We got a place. I know a guy.
Yeah.
Let's, so there it was. The idea of... We're all locked down, stuck at home for 2 years. The thought of rolling into a hotel ballroom or, God forbid, the Javits Center, just, horrible. Yeah. So when we saw pictures of this place, wait, we could set everything up outside at the beach? No one's ever done that. Let's make that happen, and here we are.
All right, so what is unique about this besides you're giving me all the benefits of being in California? Tell me what we're here to learn.
So 2,200 people, nearly half are advisors. The idea was let's not just run out the usual, here's where I think the market's going to be, here's what the Fed's going to do a year from now. Instead, let's try and come up with some people with a deep expertise in assisting the advisory community in best serving their clients. Some of that is investment management. Some of that is best practices. Literally, like if you can make a compliance panel interesting, you're doing something, pretty okay. How to communicate, how to create content, how to drive a conversation with clients and prospective clients instead of the usual, we're going to promise you we'll beat the S&P 500, and then 9 months later you're having a conversation, why didn't you beat the S&P 500?
Yeah.
So all those tools are here. Lots and lots of people with a deep expertise. We also went out of our way to make sure, we've all gone to the conferences where it's just a dude fest, and we really wanted to make sure we had more young people, more women, more people of color. We really went out of our way to say, hey, let's get everybody involved in this conversation, because diversity of thought is how you get better decisions.
Yeah, I used to always say, my salespeople would say, you've met this person. I'm like, oh, the white guy in the suit? Yeah,
Right.
Is that what that was?
Right. I've met him a million times, and I don't remember any of their names.
Right, so at least Sam has a unique look about it, so
There
people
we go.
usually remember him,
I guess that's in the name, too, of that you guys came up with, future-proof as well, right?
That was the concept, is how do you avoid having the world pass you by? And if we learned anything during the pandemic, it's not just that things change, but the pace of change is accelerating, and merely keeping up is no longer good enough. If you're just treading water, you're falling behind. Everybody is racing ahead of you. So you have to do something that's a little innovative, a little different, a little more interesting, and it means taking a risk, taking a chance. This could have very easily crashed and burned. We've all been tracking the weather the past 2 weeks. I'm like, oh, great, 105. At least it's not a tropical storm, and then the next week a tropical storm
Through
comes.
Mexico,
Right.
nonetheless.
So you have to. If you're not occasionally failing, you're not taking enough risk.
right.
This was a little bit of risk, but it was like hey, what are the odds that the weather's going to be terrible in Southern California in the middle of September? I think we have a 90% probability of doing okay. I'll take that risk every year.
Yeah. It's a lot better than market risk today. So, let's talk about this a little bit because, we're talking with advisors, people with their end clients. What conversations are being had today? I mean, we just saw another unruly inflation print. It's surprising to the upside. It looks like there's more sustained inflation pressures. How are you having dialogue with the clients these days? And how are you dealing with this idea that markets are down, my purchasing power is going down? How are you dealing with those issues?
So first, it's always about the broader context. So market's down 20%.
Yep.
Let me remind everybody, we were up 28% last year. We were up 21% the year before. 2010 to 2020 was wildly outperforming historical averages by 500 or 600 basis points. This is a feature, not a bug. And if your clients are first thinking about a downturn in the market in June 2022, you have failed to explain to them what they need to expect.
Yep.
Right? Markets go up and down. I know after, the past decade, it sort of feels like it's a one-way trip, but we spend a lot of time educating not just clients, but prospective clients. Here's what you should expect from us. Here's what you should expect from markets. Understand that the past couple of years may be atypical, and you're not investing for next month or next quarter or next year. Eye on the prize, and that's 5-10 years out. I don't believe we've ever seen a negative market print over any rolling 20-year period. So if you need your money in 1, 2, 3 years, maybe stocks are not where you want to be. Maybe you need to be something more conservative, less volatile, less potential, reduced performance. So I think if people come into a market like this with the right expectations, if you were high-fiving your clients in December, you're sending the wrong message.
Yeah.
The message last year should have been, hey, 2021 was awesome. Don't expect, this too shall pass. That was the great Solomonic wisdom. When it's bad, that's the time you want to buy. And when it's really great, you have to say, hey, eventually the wheel turns.
Barry, my mom has a question for you. I'm going to ask on behalf of Mama Lau and probably Mama Sherm as well. They're both retired,
Yep.
and it's been a challenging year. Traditional assets are down double digits, and they're both in retirement. So, what type of advice have you been giving to some of your clients? I know you manage a broad array, but for those that are on the cusp of retirement or thinking about retiring, this year or next year, or they are in retirement, do they need to work longer? Do they need to get back in the workforce? Do they just spend differently? Do they invest differently? I mean, where's
Mama Sherm wants to be chilling.
Mama Sherm be chilling all
Right.
the time.
And you can't say to somebody who's worked for 50 years, by the way, you got to get back out in the labor force.
Yeah.
That is advice that will not be well received. So part of it is understanding that we're going to see an up and down in the market. That's a given. In the beginning, earlier this year, we reduced our duration on our fixed income. The longer your duration, the more volatility you're going to see in a rising rate environment. At a certain point, alternatives to traditional treasuries start to look attractive. And I don't mean anything crazy or structured or derivative. I mean, look at munis, what you're starting to get now, especially in a high-tax state like California or New York. You're not quite 5% tax equivalent. That's a reasonable number that 5 years ago.
And those are short, by the way.
Right?
Yeah, you can get 5 on the short end of the curve.
Right.
Yeah,
So that is, and of course I say go listen to the Jeffs and get some insight into the fixed income world. But that's one of the things you have to do. You also have to think about, the typical lifespan for somebody who makes it to 75 is they're looking mid-80s, early 90s.
Yeah.
So you can't, the old days of saying, I have to completely roll back my equities because I'm 60 and retiring, the lifespan is too long to do that. 60-40, I suspect, is appropriate for people in the 70s now that wasn't appropriate 20 years ago. 20 years ago, unless it was, generational and I'm giving this to my grandkids and great-grandkids, and that point it could be 70-30 or 75-25. But today you can't just say, all right, I'm retiring, I have to roll out of equities. Doesn't mean you have to go, full arc. You could be a little more conservatively invested, but that the idea that I'm retired and I can't have equities anymore, I think the longevity has completely changed that calculation.
Right. So we've seen a lot of negativity out there, right? The narrative is pretty bad. I don't know if it's just media or the stuff we read, but you see the housing market slowing, and people think it's catastrophic, right? We always fight the last war. We think it's going to be the same thing again.
Right. It's all those subprime mortgages now.
Right. Yeah.
Blowing up.
Although I did see one coming in that said, "Bosses don't rent. Call us for a mortgage." So if you're a boss out there, make sure you're not renting according to that billboard. But you've actually seen we've seen the GDP data. You put a great article about how just the 2 consecutive negative quarters isn't a recession. You got to look under the hood. There's a lot of stuff, right? But there's mass negativity. Is this the buying opportunity, or how are you thinking that? What are you finding opportunities in today?
So we like to look out long term and think, what are we going to be seeing in 5 years? The underlying economy is pretty healthy, even with rising rates. Yeah, the Fed was late to get off of an emergency footing.
Yep.
And they were late to recognize a spike in inflation, and they're probably going to be late to recognize that they've already done enough.
Done too much, yeah.
Right? I mean, that's their history.
Right.
They're always behind the curve. I had an interesting conversation.
Because they look at data, and by the way, the data is lagged. Right? That's what they use to make decisions,
so
right?
Not only is the data lagged, but the conversation I had with Steve Leisman last night over drinks in the treehouse over there, which like all of a sudden a circle forms, and I'm like, are we talking too loudly and too drunkenly?
Yeah.
But it was about the key to the Fed model of raising rates is future inflation expectations. And you look at the history of expectations, they're not just a little off occasionally. They're terrible. As a group, inflation expectations has been consistently wrong forever. So Steve says,
normally way too high.
Right, way too high. They've been way too. So finally, after 20 years of being wrong, suddenly, oh look, inflation. They got lucky 1 out of 20 times, and suddenly. But Steve's point was, the 2 points made were, hey, you need something in your model about future inflation expectations, and my counterpoint is, if your model requires an input that is wrong, the problem is your underlying model. And if you're making rate increases based on a flawed model, it's the old joke about the general. Hey, I need my weather prediction in order to arrange our troop movement. And so, the colonel whispers in the general's ear, hey, your weather forecast, your guy, he's been terrible. He's gotten it wrong. I know, but I need it for my tactical development. That's the Fed. They need something that we know is wrong. So what do you do about that?
Well, the other thing about the Fed is that they have this embedded thinking of something called the Phillips curve, right? So the relationship between the unemployment rate and inflation. Lower unemployment drives higher inflation, and it's all about wage pressure, price pressure.
Because that worked out the past decade.
That's what I was going to say, and it was developed in like late 70s. It was almost like that Laffer curve that it was on the napkin, right? It's like, well, here's a parabolic function. Let's look at it, or it's a hyperbolic function. But point being, all of this is that they're wedded to this model because they have a dual mandate. Right. The mandate is to price stability, and I've always joked, why is 2% inflation price stability? It doesn't sound very stable to me, But they have that, and they have this full employment objective. Well, guess what? Right now, employment is good, labor market, and we know it can be lagged, right? You could nitpick it, but we're creating jobs, right? Wage growth there.
Jobs.
Wage growth there. So what changes in that Fed rhetoric? Because ultimately, they're wedded to this model. If labor stays strong, does that keep their foot on the accelerator because of that fear of perpetual inflation?
I mean, that's the $64 trillion question, isn't it? How far is too far, and how long is too long? Lower for longer, that's dead. So now is it?
And it was too long. We all agree with that.
Right. Listen, the first mistake wasn't missing inflation. The first mistake was staying on an emergency footing way past the end of the emergency. If you rather than look at consensus estimates for inflation, if you looked at the market in 20, like the second half of 2020, the market was telling you the emergency is over.
Right.
You can now remove your massive accommodation.
How about stop buying bonds?
Right.
That was the easy thing
Well,
to do. Right?
now they're doing it, so that's how they're
Right.
gonna, quantitative tightening is now going to add yet another thumb on the scale.
Yep.
But I'm not a Fed hater, and I think we have to deal with the world as it is, not as how we want it to be. I always cringe whenever anyone says, yeah, I've been underperforming for a while, but it's the Fed's fault. Well, if that's the case, you have to adjust to the reality. So the Fed's
I blame the Fed for the 100-degree weather here in Southern California.
right?
I mean, it was
they're
their fault.
to blame for the root of all evil. It used to be the Trilateral Commission 30 years ago. Now it's the Federal Reserve. So look, the Fed is a constant, right? We know they're going to make a mistake. And by the way, the research that comes out of the various Federal Reserves, they should listen to their own researchers because their research is great. There's a couple of papers out there on inflation expectations and why they're wrong, and we need something else from the Fed. And yet they just keep doing their thing. So
a lot of the inflation expectation problem, though, is anchoring bias, right? It's that we had high inflation, we expected, we had low inflation. It's resetting those expectations.
That is the problem with every single survey, every poll, every expectation is it tells you nothing about the future. It tells you, when you do a client survey and try and say with a prospective client, so what is your risk tolerance? The answer isn't their risk tolerance. The answer is, what has the market done for the past 3 months? If the market's up, I have a big tolerance. I want a lot of equities. I'm good. If the market's been down, I'm a conservative investor and I don't want any volatility. Ask the same question a year later and you get a totally different answer. So the problem with that anchoring is that humans make decisions that are irrational, and it has a very big impact on their performance and their portfolios.
So shifting that to the client side, how do you have these conversations with your clients in terms of, just had a great 2021 into a bad 2022? How are you having these conversations with these clients in terms of managing these expectations and what their biases tend to?
So an ounce of prevention is worth a pound of cure. You have to have that conversation before their clients. Let us share with you our expectation for the future. Markets will go up and down. Rates will go up and down. Bonds will do good some years. Bonds will do poorly some years. You have to be prepared that there's no free lunch. And the reason you get to outperform some years, the reason you get to make money some years, is that there's risk and volatility, and your performance expectation going forward is often going to be disappointed because the market's going to do what the market's going to do, and you can't control that. Once you accept the fact that there's a bit of a random walk to how markets go year after year, and you want to have a robust portfolio that can withstand the ups and downs, we'll let you know when the shit's hitting the fan, and we'll call you up and say, yeah, this really sucks. The quarter is looking ugly, and we have no idea when it ends, but we'll be okay on the other side. If that's the first time you're telling them that, down 20% in stocks and double digits in bonds, that is not going to be well received. But if the conversation is, hey, remember when we told you stocks go up and down, bonds go up and down, we will enter a period where none of us are going to be happy, welcome to the jungle. You're in that period right now. It's much better received when you're predicting in advance, not the market will fall 17% and the bottom is June 17th, but hey, market's going to go down and we've been in the middle of a fantastic run. This cannot go on forever. It's well received, and people are smart if you explain to them in the context that they're not getting elsewhere, right? The general media drumbeat is rotate out of this sector. Here's what you need to get your portfolio together, and dude, your portfolio is geared for 15 or 20 years from now. What do you care what happened on September 13th in 2022? I love to show people the chart of the past 40 years. Show me the 1987 crash, the worst one-day drawdown. It's a little squiggle.
It's that, yeah.
See it. But that day, it feels terrible. Ed Yardini puts together this flip book of all the headlines day by day. And when you look at them 6 months back, 6 months later, they all look like, why were we upset about any of this stuff?
Yeah. Well, I like to always say you don't short human innovation, and that there's nothing better than the United States for that, right? I mean, this is a country of innovation, and there's been dire times, and we've gotten through them every single time thus far. Maybe we're going to blow ourselves up with this, triple-digit heat, but we usually get through it.
But
So
that's a global problem. That's an absolute problem, not a relative problem.
yeah. So you talked about I picked up on the word robust on your portfolio. How do you build a robust portfolio, especially in today's market?
So basically we're indexers for the core of what we do. And if the heart of, 50, 60, 70% of your portfolio looks like some sort of a broad index, then you'll more or less get market performance. The advantage of that is you're not going to shoot the lights out in any given year.
Puts guardrails around you a little bit, right?
But you're not going to shit the bed in any given year. You're not going to be in the bottom quartile in any given year. You'll be where the market is. And Howard Marks is the one who first alerted me to this. If you're pretty much in the middle consistently over 10, 15 years, what happens over time are the guys who are up and down, those down years really crush them. But you very slowly move your way into the top half, top third, top quartile. The longer your average, the better your performance ends over time. And if you have a 10 to 20-year window, I mean, there are some portfolios that are average that are top decile.
Yep.
So that's the start. And then around it, that's the Christmas tree. The ornaments you hang on it is, hey, if you want a little value or small cap or tech or momentum or whatever flavor you like around that, that makes sense. But, I'm always surprised that Kathy likes to slag passive equity because she's like the perfect ornament for someone who's like, I'd like a little bit of that crazy alpha juice.
Right.
Let's take a shot with that. But that really should never be 70% anyone's portfolio.
Well, that's how we run our business, right? We have a total return strategy.
Right.
That's the core. It's supposed to be let you sleep well at night.
Right.
It's not going to shoot the lights out, but it's well risk managed. Then we offer like direct credit products, right? That you want some octane. Talk to our people about how to pair them together. That's the way we think about our business.
Invent this whole idea.
Oh, no, I got it from you.
Oh, okay.
I got it from you via Howard and all that. And this
Listen,
other guy,
A lot of people think that's a very solid approach because there's that itch you got to scratch. There are people who are like, I can't just be plain vanilla. Okay, so here's a little caramel, a little salt, a little chocolate. Enjoy, and as long as they can live with the bulk of their money doing what it's supposed to do, compounding over time, all the stuff around the edges, it'll be a little better, a little worse, but it won't derail them completely, and that's what matters.
So, go ahead.
Oh, go ahead.
I was going to say, so speaking of derailing completely, what is the one area, and again, not to pick on the specific funny thing, but what is the one area that you don't want your clients to touch?
So we get a lot of, hey, can you take a look at this? I'm sure you guys see this also. And
usually they want us to buy the business, but yes. Or there's a strategy already.
Or co-invest with you.
Yeah,
hey,
right.
I'm putting money in this. You guys want to co-invest?
You guys want to put $100 million in this? Yeah.
So one of the issues that you start to realize, and full credit to Ben Carlson, I don't know if he's around, for the term organizational alpha, you don't want to spend a lot of time, energy, resources looking at a one-off,
a sub 1% position, right? Yeah.
Like you really don't want to do that because A, you lack the expertise. B, the due diligence on that is really hard. C, you don't know who's full of crap. You don't know who doesn't have a track record. The legal, accounting, compliance costs are substantial. So when we see these like one-off investments, it's, hey, that's it's a liquid. There's no track record. Even if past performance isn't indicative of future performance, at least you have a frame of reference to say, all right, I think these folks know what they're doing, and this is an extension of that. So those are an issue. If there's an illiquid investment, and there has to be some form of illiquidity premium that makes sense. If someone wants, real estate was coming up a lot last year.
Yep.
If someone wants real estate exposure, hey, there are ways to get professional exposure to real estate as opposed to this particular set of multifamily homes in this town
Right.
with this. Now, is that military base staying or is that closing? How do I build that into a model? I can't do that. So those one-offs, heaven forbid, it's a restaurant or a play. We see those. Hamilton is
A play.
great-
I don't think I've been pitched a play.
A movie. How about a movie?
Not
How
yet.
about
The
that?
movie rights, yes, but definitely not a play.
So the thing that's fascinating is like restaurants are a terrible business, but a good restaurant is a big moneymaker.
Right.
And it's a whole opportunity to talk about survivorship bias.
Correct.
Hey, so you're seeing the one that's there. How many restaurants were in that exact location and failed?
Yep.
And eventually someone else did the renovation, someone else built out the kitchen. These guys came in, it was cheap, they had a good menu,
Right.
and it worked. But the previous 9 crashed and burned. You have to understand I think the whole world is survivorship bias, and when we see stuff that works around us, it gives us a skewed perspective. Success is rare, it's fragile, and it's temporary. And people need to remember that.
If you were to extend that to some of the more popular fad or FOMO trades, thinking about SPACs or NFTs or crypto, introducing those into client portfolios, how does that work into the mix, especially with something that does have a shorter track record for its history?
So I love that question. I'm trying to remember the name of the guy I interviewed who started doing SPACs in the early 2000s. Incredibly successful, tremendous track record, has done like 60 of them. If that person floats a SPAC and you want to participate in it, past performance, no guarantee of future returns, but hey, here's a person who seems to know how to find companies, how to acquire them at the right price, how to make it work. When every other Tom, Dick, and Harry launches a SPAC, when celebrities start to get involved, that always makes me wary.
But fortune favors the brave, Barry. Fortune favors the brave.
Right. Look at every celebrity crypto endorsement, and then draw a chart on it.
And then go watch the South Park episode about it. Hilarious,
which is
by the way.
just unbelievably accurate. and
They crush it.
insightful.
Yeah.
But every one of these charts is a ski slope in Vail. That's what they look like. So we haven't even really talked about private equity. Sometimes the universe says, hey, this is becoming a little crowded and you need to be very selective in where you go with private equity. I'm thrilled that Kim Kardashian is now in the space, because how does that not at least put people on alert? Hey, you really have to kick the tires, because some of this stuff is just famous people putting their names on crap. It didn't work out all that well with crypto. I don't know how well it's going to work out with private equity.
All right, well, let's talk about private equity. So a lot of people over the last couple of years, especially with public markets where valuation was, the excuse was bonds. And we agreed in some capacity, like bonds were ridiculously overvalued out in the marketplace. Now,
40-year bull market will do that.
Yeah, and you know what? At this point, they're starting to look pretty dang attractive. But on the other side, people said valuation's rich in public. Let me just put some stuff into private. So how do you guys think about that with your clientele, about allocating to VC, private equity? And again, are you doing it for the protect them from themselves because of the illiquidity? How do you think about those markets?
So we don't sell private equity, but we allow people to buy it. We have a platform, we have a number of different offerings. If somebody says, I really would like something that's diversified and not public, we can show them some things. However, there are a lot of asterisks with private equity. Markets down 20, 25%. Private equity holding up pretty well.
Yeah.
Must be nice not to have to mark to an actual price every tick every day, every month.
Well,
every
on that note, I got a statement from a fund, and it was the second quarter update, and it was up. And I'm like, what?
You guys are the best.
I clicked it.
Can I send you more money?
Yeah, I opened it, and they sold one company, made money, and everything else is at cost.
Right.
I mean, what a great market.
So the only decent argument I've heard is, hey, when everything gets dicey and people start lowering their ask price for the sort of deals we can do, we have an opportunity in a low market to buy into privates cheap. But the pushback to that is, now do public markets. Oh, wait, when they come down, you get to buy into public markets cheap also? The difference is public markets get their mark all the time.
Yep.
So we looked at a couple of real estate funds. There's a farmland fund that looks pretty interesting. And what made the farmland fund appear a little different than some of the private equity is we do a full audit and a full comparable on 25% of our holdings every quarter. So each year our marks are about as updated as you're going to get in real estate. And that sort of approach where
There's no Zillow for farmland.
that's right. You're not marking to fantasy. You're marking to real comparables. Look, if you're geographically in the same area and I grow corn and he grows corn and I have access to these water rights and he has access to these water rights, you more or less can say these are comparable and that was sold. So you have some rational per acre basis, like they have it institutionalized.
Sure.
And I think there hasn't been pressure on PE other than a handful of people like Dan Rasmussen, who's been saying their marks are all made up. The ROI is fabricated. He's painting
Right.
with a very broad brush, but it raises the issue, hey, you guys need to be a little more current in your marks, but, that's a whole nother issue.
So what's attractive today in the public markets? I mean, we're down about 12% on the in the Bloomberg U.S. bond aggregate. Probably after today, we're down probably mid to high teens in the S&P 500. Are things starting to look a little bit more attractive again, or you kind of just wait and see how things go as some of these uncertainties become a little bit more clear?
Right. Well, the future is always inherently unknowable and uncertain, so I'm not a big fan of the uncertainty meme. Uncertainty means that we're really nervous. Most of the time, we're busy lying to ourselves, and that gives us a degree of comfort. So no one knows what now. I don't remember a whole lot of people in December of 21 saying, all right, strap yourself in. The next 6 months are going to be a shit show. The future was just as uncertain back in December. We had just lulled ourselves into a very comfortable stupor. And that's how we operate. That's human nature. We talked a little bit about munis. If you're in a high tax state, if you're in a blue state, and you could get 4.5, almost 5% tax equivalent, people would have killed for that 5 years ago. That's really attractive. When we look at the equity market,
By the way, a year ago, high yield, the broad index didn't even yield that.
right, that's
Right?
right.
For junk bonds.
Right.
Right?
And what are hey, they're yielding 9-10%.
Yeah.
I don't think there's a whole lot of risk in junk now. Do
No,
you? What
no.
are your thoughts?
I mean, look, I think right now, if you want to take risk, you should take risk in the bond market. And I'm not talking about buying T-bills. I'm talking about buying credit. I'm talking about down capital structure. I'm talking about lower rated. You can
private
put
credit. You're talking.
I'm talking public markets.
Yeah.
Public markets. We have a fund, of course, but it yields like 13 right now.
What's the risk on a 13 yielder?
The risk is you're probably down 10.
Okay.
And you know what? The stock market, is it going to give you 13 next year? I don't know. None of us know. But it could easily go down 20.
12.7 is a real chance, but 13. Right?
No way. 12.7's as far as it goes. Yeah. So I mean, look, I think that there's interesting things where it has a different risk profile, right? The asymmetry of it, right?
Right.
And look, are you going to have some defaults? Yes. Are you getting 13? Maybe not. But it looks like you can get 10 easy
Right.
with a defaulted environment.
So
With a recession, right?
So here's where we are. How much of the recession is priced in? We really don't know because we don't know how far the Fed is going to go.
Right.
So where was inflation this morning?
It was 8.3.
All right. So we're at 2
He's all
and a
questioning
quarter,
me.
2.5.
Yeah.
Flip the
Yeah.
script on you.
So even if the Fed manages to take rates up to 4%, right? They're still negative here. So
Yep.
we have to deal with that. So
But that's contemporaneous inflation, right?
Right.
And everything. That's
That's
not necessarily what it looks like in a year's time, right?
So here's how I look at opportunity in the equity market.
Yep.
You have a massive reset in 2020, a 34% down move. That kind of starts the clock over again.
Yep.
You end up with the biggest fiscal stimulus in history. CARES Act 1 was $2 trillion in a $20 trillion economy. We've never done 10% of GDP. Oh, let's add CARES Act 2 to that, another $1 trillion. Oh, really? Hold my beer. Here's CARES Act. So the first two under Trump, the third one under Biden.
Yep.
CARES Act 3. On top of CARES Act 3, here's an infrastructure bill. Oh, by the way, the inflation bill.
No, it's inflation reduction. If we
Right?
print money and spend it, it will reduce inflation, Barry.
Now, to me, the best inflation hedge looks like in the out years is going to be equities. Seems companies have the ability to pass along cost increases.
Sure have. Yeah.
Or just say, we don't have any cost increases, but who's going to notice? Raise prices 20.
Have you looked at the margin chart on the S&P 500? It's the
Pretty-
highest
pretty
it's been in
amazing.
like 45 years.
Pretty amazing, right.
45 years. In this economy right now, the margins on the S&P 500 are the highest they've been in 40 years.
Plus, when we look at the labor market, so you have a ton of people who retired early, a lot of people who died during COVID. Immigration has been on a downtrend.
Right.
People want to blame Trump, but Biden has more or less continued many similar policies.
Yep.
But it goes back 15 years. The number of immigrants coming into the country, legal immigrants,
Right.
has been falling. That's before we talk about 30 million people with long COVID in the U.S. So the labor market is dramatically reduced from what it should be. We can fix it by, doing all the green cards, doing all the HB1 visas, letting more skilled immigrants in and unskilled immigrants, because lots of jobs. The reason it takes you 20 minutes to get a coffee at Starbucks out here
Yep.
is that there aren't enough people willing to take those jobs. Bring folks in, let them take jobs, but that gives you a sense, back to the word robust, of how strong the underlying economy is. And keep in mind, the Fed is dealing with inflation today, but we've had, 20 years, 30 years of technology-driven deflation.
Yep.
International trade, automation, technology.
Outsourcing jobs to other
Right.
countries, right?
So some of that is now going to reverse, right? And we've had deflation in wages up until a year or two ago. So some of that's going to reverse, but the key thing is we got a little complacent. We allowed our supply chains to become brittle. We didn't bring enough laborers. We took it for granted that we'll always have minimum wage people. We could pay $8 an hour to do the grunge work. That's done. We need a response that comes up with that. But when I'm looking at this circumstance out a couple of years from now, it's hard not to be bullish on where the U.S. is. We haven't talked about the dollar. Wherever you look in the world, currencies are always relative. If the dollar is this strong, what is that telling us about Europe, about Asia, about Japan?
Says it's the best country to be in right now.
Right.
You bring up the labor, and I have an anecdote for that, which is dangerous, to extrapolate. But my nephew has started to live with us, and he's going to community college, and he got him a job at the donut shop. Donut shop. What do you think he gets paid at the donut shop?
$15 an hour.
$16.50 to start. He got a raise already. 2 months in. Shout out to Gage. Good job. He's making $18 now. And he just got a promotion. This is like being on one of your shows. Now he's the doughboy. So I was calling him Ice Cube. He didn't get the reference. But anyway, when you look at that, and it is a supply shortage of things, right? And so, how do we entice people back into this labor force? Because I think preferences change, as you said, like the evolution. We're talking about the future. How do we change that dynamic to get us to where we are sustainable and we don't have to rely on a lot of foreign demand or foreign supply chains and the like?
So we're starting to do some of that, onshoring a bunch of the semiconductor bill and building a bunch of chip companies here is going to be a start. I don't know if that's enough. Just-in-time inventory is one of those things that
it's gone. It's gone, right? Yeah, right.
Well, it's gone for now. We'll see how long people start saying, hey, if we reduce our inventory supply.
Well, I think of Walmart and Target, how they struggled. They mismanaged it. It's not necessarily that there's a bad thing going on. It looks like a mismanagement and assuming previous trends, pre-COVID trends versus adapting, right?
The other thing that I think the takeaway for me from the pandemic is you lock people in their houses for 2 years and you give them $1.4 trillion in unemployment, they're going to find a way to upskill, to improve their abilities, their certification. We have had record new job formation in 2020, 2021. It's starting to plateau in 2022, but millions of people basically have quit and said, I could do my own thing. I could create an app. I could develop a service. I could share my labor with someone and get paid for it rather than working in a traditional office. And that dynamic has not finished running out. That's what we're going to be wrestling with over the next couple of years. Okay. The whole work from home phenomena, the whole Do I really need to be in the office 9 to 5, 4 or 5 days a week? In the beginning of the pandemic, I was skeptical that was going to change for everybody else. We had always been remote. When we launched our firm in 2013, we had clients all over the country. We had people working remote. Everybody didn't have to come into the New York office. The New York office now is something like 15% of our staff. Lots of people are working virtually, working remote. And in New York, we're in 2 days, 3 days a week. We don't feel the need to go in every day. How that plays out over the next couple of years is going to be a big driver of the labor force, wages. I think eventually inflation subsides because the drivers of inflation have been the pandemic, the lockdown, the supply chain snafus, and the shift from services to demand to goods.
Yeah.
When everybody's stuck at home, you're not going to the movies. You're buying big screens.
Yeah. I thought that would have subsided earlier. I got that wrong. I thought by the end of 20, we would be shifting back to services. That was too early.
That was ongoing.
Right,
and keep in mind, post 08, 09, lots of contractors, electricians, masons, carpenters left that field.
Right.
So that was a smaller group. And there was go try and get a decent contractor now. It takes a while. So I think those changes are going to have a longer lasting effect. And the question is, what does that do to local real estate prices? If I don't have to have an office in Midtown Manhattan, if I can open up a branch out here, although this isn't exactly a low rent part of town,
Yeah.
but if I can open up a branch wherever I want that's inexpensive, think about what that does to the urban core and the ability to charge top price for those sorts of things. It has to have a deflationary impact eventually.
Eventually.
Yep. So, Barry, I wanted to shift gears a little bit and bring it back to the wealth advisory business. You've been in this business a long time. You've seen trends and changes. What are some of the current trends that you're seeing? Because, I mean, the idea of model-based business that is given to you by a robot. Robo-based advising, target date funds seem to be something that's a little bit on the rise. How do you see that changing your business? I mean, part of it's on something that you were talking about before, indexing, right? So that's changed our business on the investment management side where people are gravitating towards and using the index funds more. How are people, what do you think about the robo-advisory and the rise of these models that basically, I'm guessing a lot of these models that are offered by some of these brokerage houses all kind of fit the same thing. How old are you? When do you want to retire? Let's put you into some...
What's your savings rate? What's your income? Where do you want to go?
Yeah.
So look, the beauty of the robo-advisors is that for a long time, if you're starting out with 5 or 50 or 250, big firms didn't want anything to do with you, right? I remember a couple of years ago, a memo went out. I don't remember if this...
And those were thousands you're talking, not millions. Yeah,
right.
$250,000.
The memo goes out at, I don't remember if it was Merrill or Morgan, but hey, if you have a sub 250 client, you can't charge commission on it. You can't charge any fees on it because they just wasn't worth their time, effort, compliance to deal with it. So Betterment, Wealthfront, these other robos step in. Eventually, Robinhood steps in. The ability to give somebody a decent portfolio that makes a little sense for 25 or 50 basis points seems like an improvement of just leaving them to themselves. So we have a basic robo, and we have a step up that gives you a dedicated advisor if you're a young investor, but you don't want to do it by yourself, but you don't want to pay full boat. This sort of splits the difference, and you have an advisor. You're probably not looking for tax harvesting or dealing with capital gains or estate planning or all the things that a full fee RIA is going to provide for you. So if you're not using those services, why pay the ride for that? So that's one aspect of it. People always have the ability to go out and do it themselves. So if you're an advisor, you have to bring something to the table. You have to be value add. Some of it is behavioral counseling. Some of it is just being a sounding board. And some of it is just talking people off the ledge when the first half of the year goes by and it's like, this whole thing is a rig and I want out. It's like, well, look at it over time. This is not unusual. This happens. So if you can bring that to a client, that's an advantage. But the fact that we now have such a wide array of offerings, you want to do it yourself with Vanguard or BlackRock, go ahead. You want to do a robo-advisor for 25 or 50 bips, you can do that. You want to tee up something where someone's giving you personal, a little bit beyond the robo, that's available. You want a full suite of services because you're too busy in your career and you know that you need to invest for the rest of your life, that's available. Think back, I'm not talking 50 years ago, 10, 15 years ago, this suite of services was much, much smaller and really aimed at the very well-heeled. So we haven't quite democratized finance. I'm old enough to remember the Merrill Lynch thundering herd. Like, Merrill Lynch was the first real broker that said, hey, we're going to give everybody access to investing, but their everybody was doctors, lawyers, upper middle class. That top 20, 30% is now the full spectrum of investors, has to be a huge improvement for the state of people's investing long term.
Yeah, you mentioned talking people off the ledge. We have an investment team of about 105 individuals, and we had to have some counseling for them as well. So don't worry. You know, it was an ugly market, and we got to keep your cooler heads prevail, right?
So quick story about that. Bill McNabb was CEO of Vanguard in the financial crisis, and they have thousands of CFPs who work their phones.
Yeah.
Clients call up. And they occasionally, he tells the story of, they occasionally listen in as just, calls may be monitored for service. And they listen into a bunch of client service calls, and the people on the calls, the client sounds almost as nervous as the advisors, as the CFPs. So Vanguard sends out a all points, meeting. Everybody comes to this meeting, and here's the deal. There's going to be no layoffs. We're bringing in money every month in 2008, and nobody's going to lose their job. You have to be confident that you're going to get through this and your client's going to get through it. And that pretty much lit Vanguard up, and that's when they started passing $1 trillion and then $2 trillion. So sometimes you have to talk the advisors off the shelf because it's not just their investments, it's also their careers.
Their careers, right, yeah. So, Barry, it's been a great conversation. We kind of did a tour of the world, but there's one part that we have to do before we go, and that's Sam's favorite part of the show.
Let's do it.
All right, Barry, that favorite part of the show is called Sherman Says. I'm going to offer a series of alternating prompts between you and Jeff. I'm watching the countdown timer right now. It's about to hit 2 minutes, so we're going to go old school. One word replies, concise, top of mind, one word.
Wow.
Do you think that the time limit helps us with that?
Let's go. Let's
on the chess
time's
clock.
Ticking,
All right.
ticking. All right, Sherman, shrinkflation.
Everywhere.
Drought.
Problematic.
Nuclear energy.
Huh.
Never gonna happen.
I don't feel like it's good. I always heard how clean it was. See, I already screwed this up. Yeah. Pass.
Crypto winner.
Here.
OPEC.
Useless.
Energy prices.
89 straight days down of gasoline. Impressive.
All you got to do is tap into Strategic Petroleum Reserve, right? That has like 2 days of supply in it. Anyway, yeah.
Yeah, it's down back to the early 80s levels now, and we hear that they're looking to pump out some more into the inventory or release the hounds.
Big hair bands will come also. That'll be good.
That'd be sweet. You did use Welcome to the Jungle earlier.
Right.
So, yeah.
All right, where was I? Let's see. Services inflation. To you, Sherman.
Continuing to rise. Don't sleep on housing. It's not in there. It's going to be sticky, and it's going up. We saw it big time again today, and I think it continues.
All right. Buy the dip or sell the eventual rip?
Both.
Cash.
Sexy.
And then the last one here to wrap it up, the blog. I messed that up. The blog father.
Fun to be.
All right.
All right. So if you don't know, Barry is the blog father. So there you go. Thanks, everyone, for joining us. We really appreciate it. Thanks, Barry.
Hey, man.
Always
This
a
was a lot of
pleasure.
fun.
It's always fun talking
See
to
you
you.
again, Barry.
All
Thank
All
you.
right.